Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Trilogy Metals.
If you find our talks useful, please consider subscribe, like, and comment underneath. I want you to imagine looking at your portfolio right now, and you see a company that just missed its quarterly earnings estimates by, well, an eye-watering 300%. I mean, your immediate, entirely human instinct is probably just to run as fast as you can.
Oh, absolutely. Yeah, hit the sell button, don't look back.
Exactly. But what if that exact same company had nearly $50 million just sitting safely in the bank? And on top of that, the United States Department of War was actively maneuvering to become a major shareholder. Today, we are really focusing on a pre-revenue developer that sits right at this crazy intersection of, retail investor panic and massive sovereign-level strategy. It currently holds an 8 out of 10 bullish score on the sentiment scale, and we're going to unpack how a really catastrophic-looking earnings headline might actually just be masking what we call a fortress of liquidity.
Yeah, and that juxtaposition is what makes this such a compelling case study for you, especially if you're trying to build long-term wealth in the resource sector. Because usually when you're evaluating a junior mining stock, you're looking at a purely private enterprise, right?
Yeah.
Like they are completely at the mercy of the commodities market.
It's a brutal space.
It is notoriously brutal. But when sovereign interests, like the U.S. government, begin intertwining with a publicly traded entity, well, the entire risk profile and, honestly, the potential upside has to be totally reevaluated from the ground up.
Right. Okay, so let's unpack this because right out of the gate, we really have to address the elephant in the room, which is that glaring, ugly number that shook the market. I mean, if our goal here is wealth building, justifying a position in a company that looks like it's hemorrhaging money takes some serious work.
It really does.
So on April 2nd, their Q1 2026 earnings report dropped, and it caused a fairly brutal shakeout. They reported a net loss of $7.1 million. And that is a steep climb from the $3.6 million loss the year prior. The earnings per share came in at -4 cents, which missed the estimated -1 cent by that massive 300% margin. It feels like, I don't know, deliberately buying a house with a collapsed roof. You know it's bleeding cash, so why on earth would you willingly take on that liability?
Or that reaction is completely logical, right? When the trading algorithms start flashing red and the headlines are just screaming about a massive miss, your initial instinct is to dump the stock. And honestly, a significant portion of the retail market did just that during that early April shakeout.
They totally capitulated.
Exactly. But the true picture only emerges when you stop reacting to the headline and actually read through their quarterly financial report, like the actual 10Q filing. What's fascinating here is that in the development phase of any major mining project, standard accounting practices can create these terrifying illusions. That $7.1 million loss, it was driven almost entirely by non-cash items.
Okay, wait, let's make sure that mechanism is crystal clear for everyone listening right now. When you say non-cash items, you mean zero actual dollars left the company's checking account to pay for those specific line items.
Yes, precisely $0. We are looking at two major accounting entries here that explain the miss. First, there was a $1.5 million mark-to-market derivative liability.
Which sounds incredibly complicated.
It sounds worse than it is. It's basically just a paper adjustment. It reflects the changing theoretical value of financial instruments the company holds, which are tied to current market conditions. It's an accounting rule, not a cash expense.
Got it.
And second, there was $3.1 million in stock-based compensation. So they are paying employees or executives in company shares rather than draining their actual cash reserves. Now, it hits the official income statement as a financial loss, sure, but the actual cash balance remains completely untouched.
Okay, so it's like hiring a contractor to completely renovate your house, but instead of paying them out of your checking account, you give them a tiny percentage of the equity in the house itself. Your actual cash on hand hasn't dropped by a single penny. So the floor isn't getting wet from that leaky roof. It's literally just a clerical error on the blueprint.
That is a perfect way to look at it. If you strip out those non-cash paper charges, the actual money being spent to keep the lights on and advance the project is heavily managed. It's entirely in line with expectations. Which brings us to the ultimate defense mechanism for any pre-revenue company, and that is the balance sheet. As of February 28, 2026, this company held $37.8 million in actual hard cash.
$47.8 million in the bank. For a miner that isn't even producing yet, that is massive. I mean, the absolute biggest wealth killer for investors in this space is dilution.
Oh, 100%.
When these junior companies run out of money, they are forced to print more shares to survive, which instantly shrinks the slice of the pie that you already own. Having almost 50 million on hand basically builds a moat around your investment. They can execute on their technical milestones without being forced to go back to the market with their hat in their hand anytime soon.
Yeah, and financial flexibility at this stage is a massive competitive advantage. They have the runway to pivot aggressively toward development while the broader macro environment for critical metals matures. But, and this is a big but, getting a mine into actual production takes hundreds of millions, if not billions of dollars. They aren't going to finance the actual construction out of that $48 million checking account.
Right, 48 million is just walking around money when you're building a mine.
Exactly. And they certainly aren't walking into a traditional commercial bank for a loan of that size.
So here is where the narrative shifts from just a standard mining play to something highly, highly unusual. Because transitioning to a strategic producer requires astronomical capital, and they are tapping into a sovereign-level commitment to get it. We are talking about a pending $35.6 million U.S. federal strategic investment coming directly from the Department of War.
And seeing the DOW step into a public equity situation is incredibly rare. It really represents the defining characteristic of this entire thesis. Of that 35.6 million, 17.8 million is earmarked directly for the company in exchange for equity units. That translates to roughly 10% of their outstanding shares. Think about that. The United States government is fundamentally buying an ownership stake in the operation.
That is wild. To borrow our real estate analogy again, this isn't just securing a mortgage from a bank. This is like having the United States military co-sign your mortgage and then move into your guest room to make sure nobody ever breaks in.
Yeah, that's exactly what it is.
It is an overwhelming vote of confidence. But there has to be a specific catalyst for this, right? Like, what makes this particular patch of dirt in Alaska so critical that the Department of War is actually deploying capital?
Well, the asset in question creates what we can call a strategic asset moat. The company holds a 50% interest in the Upper Kobuk mineral projects, which are located in the Alaskan wilderness. And within that specific project area sits the Arctic deposit. This deposit contains approximately 50 million tons of ore. But the defining metric here, the thing that changes everything, is the grade. It is a massive 5.6% copper equivalent.
Okay, for anyone who doesn't spend their weekends, reading geological surveys, which is probably most of us, let's contextualize that 5.6% because it fundamentally changes the math of the business.
It really does.
To get the same amount of copper out of a standard, say, 1% grade mine, you have to run 5 times the amount of dump trucks, you have to pack 5 times the amount of dynamite, and you burn 5 times the diesel fuel. That 5.6% grade isn't just a neat piece of trivia for a brochure. It is a massive built-in operational discount.
And you have to remember the global average grade of copper being mined today is in a state of steady decline. There are many major legacy operations out there digging up rock well under 1%. So the sheer cost advantage of processing less rock for way more metal makes the underlying economics of the Arctic deposit incredibly robust. But the grade is really only half the equation for the Department of War.
Right.
The other half is geography. This deposit is on U.S. soil.
Which brings us to the whole national security angle. Because copper is the absolute backbone of the modern energy grid, not to mention the military-industrial complex, you just cannot build advanced defense systems or upgrade power grids or manufacture electric vehicles without absolute oceans of copper.
You really can't.
And right now, relying on foreign supply chains, especially ones routed through geopolitical rivals or, volatile shipping lanes, is a massive vulnerability for the U.S.
Exactly. The strategic mandate right now is to onshore critical mineral supply chains. When the U.S. government takes a 10% equity stake in a domestic resource of this caliber, they're effectively establishing a floor valuation for the stock. It acts as a sovereign put option.
Let's hover on that. A put option, meaning it protects investors against extreme downside risk. The government is basically signaling to the market, hey, we have done the due diligence, we value this asset at a premium, and we have a vested national security interest in ensuring this project does not fail.
Right. By de-risking the Treasury and replacing costly traditional mining finance with government-backed partnership capital, the project becomes insulated. It's insulated from the kind of foreign supply chain disruptions that cripple competitors. It is a level of regulatory and financial armor that simply cannot be replicated by private enterprise alone.
Wow. Okay, so we have a world-class, high-grade copper asset. We have a $50 million cash fortress preventing dilution. And we have the Department of War literally buying into the cap table to secure national interests. I mean, it paints an incredibly bullish picture. But if you are building a portfolio, you always have to look for the trapdoor, right?
Always.
And the catch here is entirely geographical. All of this world-class copper is sitting in the remote Alaskan wilderness, and currently there is no road to get the ore out to the market.
Yeah, that is the big hurdle. You cannot helicopter millions of tons of industrial metal out of the tundra. Infrastructure dependency is the primary bear case here. It is the defining risk factor weighing on the stock price. The entire valuation of the Arctic deposit, along with the neighboring Bornite deposit, relies completely on the Ambler Access Project.
Also heavily referred to as the Ambler Road, right?
Exactly. It is a proposed industrial corridor meant to connect the mining district to existing state infrastructure. And as of right now, it is neither fully financed nor built.
And waiting on massive government infrastructure projects can feel like watching a glacier move. I mean, there are endless environmental reviews, permitting battles, funding negotiations. It kind of begs the question, if this road is the only bottleneck holding up a critical national security asset, shouldn't the government just step in and build the road themselves rather than waiting for private capital to figure it out?
Well, that realization is exactly what is rapidly shifting the narrative right now, and it's mitigating that execution risk. First, we recently saw a major bureaucratic roadblock removed. Public Land Order 7966 officially opened up 2.1 million acres of federal land in the area for mineral entry. It essentially cuts the red tape across a massive swath of the district.
So the regulatory ice is thawing, basically. But paving a heavy-haul industrial road across Alaska requires massive capital. Are there whispers of the government actually putting their money where their mouth is regarding the infrastructure itself?
Oh, there are more than whispers. This is where a massive speculative catalyst comes into play for you as an investor. Based on recent indications from the U.S. Interior Secretary, the White House is actively considering participating in the financing of the Ambler Road. And not merely as a guarantor backing a loan, but as an actual equity partner in the infrastructure itself.
Okay, that is the blue sky scenario. If the federal government buys an equity stake in the literal driveway leading up to the mine, the timeline and funding mechanisms become infinitely more reliable. Furthermore, you have South 32, which is a major global mining powerhouse sitting as the joint venture partner on this project, and they are continually reaffirming their financial commitment.
Right, so if we connect this to the bigger picture, combining the unlocking of federal lands, the staunch support of a major joint venture partner, and the very real potential for federal equity in the road itself, it shifts the Ambler Access Project from just a speculative concept to an urgent national priority. While execution risk remains a factor you must weigh, federal participation would unlock billions of dollars in dormant value. And not just for this specific company, but for the entire mining district.
That's huge. Let's ground this macro narrative in the actual numbers on the screen, though, because with the cash, the copper grades, the government backing, and the shifting infrastructure dynamics, how is the market currently pricing this stock? If you are an investor evaluating this today, the valuation disconnect is staggering. Right now, the stock's price to net asset value, or PNAV, is sitting under 0.2 times.
And for context, net asset value is basically a calculation of what the company's underlying assets, so the dirt, the cash, the equipment, what they would be worth if you liquidated them today minus liabilities. Trading at less than 0.2 times that value represents a profound, deep discount.
It's essentially trading at 20 cents on the dollar.
Exactly. This is the hallmark of capitulation selling. It's where impatient retail investors who don't understand those 10Q mechanics we talked about earlier simply throw in the towel.
Which creates a massive opportunity for wealth builders who are actually paying attention to the fundamentals. Seeking Alpha recently categorized this as a speculative, medium-risk, high-reward play. And the risk is capped because of that Department of War safety net we discussed, leaving that high-reward potential wide open for a mean reversion rally. And we have already seen how violently this stock can move when the macro winds shift, right? After that April 2nd earnings flush, the entire sector caught a massive bid on April 8th.
Oh, yeah, the price action on April 8th perfectly illustrates the mechanics of a high beta stock.
Right, and because it's a high beta stock, it essentially acts like a magnifying glass for the overall market sentiment. If the broader copper sector takes a step forward, a high beta stock takes a massive leap. It amplifies the volatility in both directions.
Precisely. And the macro setup driving that April 8th rally was incredibly potent. We had a weakening U.S. dollar, rising expectations of interest rate cuts from the Federal Reserve, and a de-escalation in geopolitical tensions following the U.S.-Iran ceasefire. All of those factors make commodities, and specifically critical metals, significantly more attractive to institutional capital. This stock, given its deep discount and high beta nature, amplified those tailwinds instantly.
Now, if I am an investor looking at that government floor valuation, I don't want to just park my money and wait blindly in the dark. I need to know when the rubber meets the road. When do these government promises and macro tailwinds turn into actual tangible catalysts? Let's walk through the roadmap for the next few months because there are some big dates coming up.
Yeah, the transition from the noise of March and April into a purely catalyst-driven environment gives you a highly defined roadmap. First up is May 13, 2026. That's the annual general meeting. Management will be on the hook to provide forward operational guidance and set expectations for the summer.
Right, but the true binary event, the one that turns theory into reality, hits just a few weeks later.
Yes, May 31st, 2026. This is the absolute hard deadline established in the amended letter of intent for the $35.6 million Department of War investment to officially close. When that deal finalizes, it transitions the government backing from a signed promise into actual cash in the bank. That event alone carries the potential to trigger a major re-rating of the stock price as institutional algorithms recalculate the de-risked valuation.
So May 31st is absolutely the date to circle in thick red ink on your calendar. But, a mining company actually has to prove out the dirt eventually, which brings us to the operational catalyst, the Q2 field season kickoff. The joint venture, Ambler Metals, has a $35 million work program completely funded and approved for the summer.
And that is so critical because continuous news flow is the lifeblood of a developer's stock price. Throughout the summer, drills will be turning at both the Arctic and Bornite projects. As assay results come back from the lab confirming or expanding the deposit size, it provides fresh, concrete data for the market to digest. It keeps the stock top of mind for resource investors.
So you aren't just buying a ticker symbol and hoping for the best. You are buying ahead of a highly scheduled series of validation events. Let's synthesize the core takeaway here for your portfolio. We are looking at an opportunity that scores an 8 out of 10 on the bullish scale. It is a remarkably rare chance to buy into a world-class 5.6% high-grade copper asset at an extreme discount trading under 0.2 times its true net asset value. And you get to do it with a built-in safety net provided by the United States military.
Yeah, but the strategic approach here requires a target horizon of 12 to 18 months. This is not a day trading vehicle. You take a position to capture the closing of the Department of War investment at the end of May, you ride the continuous news flow of the 2026 summer drilling program, and you wait for concrete structural updates regarding the Ambler Road infrastructure financing. As those specific milestones are achieved, the transition from a speculative, discounted explorer to a strategically vital producer takes shape, which renders the current valuation totally obsolete.
It is an incredibly compelling setup for wealth building. But as you evaluate this within the context of your broader portfolio, there is a much larger, frankly provocative question to consider. We are currently watching the U.S. government actively negotiate to take direct equity stakes in raw dirt, and potentially even the remote industrial roads leading to that dirt, simply to secure access to critical minerals like copper. I mean, it is a massive paradigm shift in how capital flows into the resource sector. If the government is willing to take this unprecedented step in the Alaskan wilderness today, how long until they start evaluating other strategic miners through the exact same lens?
The implications of that shift are staggering. What we are analyzing today might not just be a single, deeply discounted stock play. It could very well serve as the early blueprint for an entirely new era of nationalized resource security, permanently altering how the market values domestic critical metals.
And if that era is truly beginning, the traditional rules for valuing these assets are about to be completely rewritten. Thank you for joining us today, and we'll see you next time.